You say stay defensive in the U.S. and look to Europe, Germany and France specifically?
I think so. If you're looking in terms of equity markets, you really want to be playing for the places where growth has been stunted and where policy is actually a tailwind. And so we know that the ECB has actually made the case that they will be very aggressive in 2015. And if you look at the U.S. market, which has never gone up ever, 7 years in a row, although we haven't had policy like this ever, on a relative value, that might be the trade.
I'm wondering if you have a client who says, look, I'm willing to take as much risk as you can feed me. What's the riskiest bet that you would be willing to advise on?
So if you looked out into the equity markets in Latin America, which has been beaten up for the last 2 years, down almost 25% in the last 2 years, that might be a place to look. The open door with Cuba that's started talks again about potential normalization, the talks that broke off in 2013.
Who does that benefit, though? Which market specifically?
Well, all of Latin America as a region, but probably most particular, and coming up with the Olympics, would be Brazil, which has also had its troubles over the course of the last couple of years. A large component piece of that index, and EEML would probably be the best way to get exposure there.
Pim asked about risk-taking. What about private equity, venture capital? Is that as risky as it once was, or is it becoming a little bit more of a safer investment?
Well, I think those who have longer time horizons and those who have particular liability matching that we've heard a lot about this year are looking to those types of asset classes for the kinds of yields that we've been able to see or get extracted from them. The private equity piece, I think for those who are looking for larger gains longer down the road, is a more safe place than it was, say, in 2000, last time we saw NASDAQ at levels like this. But investors, of course, it's about the vintage and the actual investment itself. So.
And they're locked up for years to come. Very quickly here, the final thought on U.S. housing. You say it'll flatline in 2015. Yes.
So if we think that investors are anticipating, and whether or not the Fed actually moves in 2016, or 2015 rather, who knows? But I think investors will actually be anticipating that uptick in rates, and that will cause a flatline in interest in housing.